Hello and happy end of March, everyone. Whether you're joining us live this morning or catching the recording this afternoon, this evening, in the coming days, thank you for spending your time with us. I'm Becky Binsfeld, and I lead our client education initiatives at Compeer Financial. Today, I'm joined by Bill Moore, Compeer's Chief Risk Officer. Bill, welcome. Thanks for being with us today.
Thanks, Becky.
Thank you. Before we get started with all of your great content, I want to just set the stage for our audience a little bit here today. Where we sit now, it's been just over a month since the first headlines on the war in Ukraine and the subsequent impacts at home and abroad on the markets, on commodity prices. And at the same time, we're hearing more and more about the impacts of inflation, what it means for interest rates. With so many economic drivers making headlines, it's hard to know how to sort through what it means for us, for agriculture, and for rural America here at home. So for those of us joining live this morning, if you have questions, please feel free to put them in the comments as we move along. Otherwise, I'm going to turn it over to you, Bill, and I have a few questions for you. There's a lot going on in the world, like we said, that will likely affect the economic landscape for the next year or maybe longer. If we were to set the table right now, where are we sitting from an economics perspective?
Yeah, great question, Becky. In fact, unfortunately, we're doing this virtually. So if I say something that offends anyone, no one can come up on stage and slap me. So I'm all set from that perspective. We are in a really interesting spot. It's been a crazy couple of years economically. We were really kind of humming along in the late 2010s. And there were signs that a recession or at least a slowdown was upon us. But then we essentially tanked our own economy, so somewhat on purpose. And so we had a real strong downturn economically in 2020, and we've spent the last year and a half trying to build that back. 2021 had really good GDP numbers. We grew 5.6%, which is extremely strong. But if you draw a line from where we were in the fourth quarter of 2019, we're actually still 1% below where that trend line would have suggested we would have been otherwise. So we've not really caught back up to where we were before COVID. Now, the good news is we've kind of worked the unemployment number back down. We're at about 3.8% unemployment rate. But you do have to recognize the fact that that number is actually an equation of two different factors. And one of them is people in the workforce, and a number of people have left the workforce. And in fact, today we have more job openings than we have people looking for jobs. So that's created a lot of pricing pressure among all the other pricing pressure we're seeing between the supply chain and a number of other items. And in fact, our inflation number for the last year was 5.6% at what's called the CPE, or the consumer price index, which tends to affect you and I a little bit more, was the last month was almost 8%, which was really large. And in fact, it's caused the Fed to start rethinking about where it needs to be, because it has really two jobs at the Fed. Their mandate is to have full employment, and we're kind of clearly at that at this moment, and maintain a appropriate level of inflation. And once Pandora opens that box, I'll mix my metaphors here, or I'll double my metaphors. It's hard to get the genie back in the bottle. And inflation's really tough to fight. And that's probably going to be the overwhelming driving economic indicator for the next year plus, is can we rail that back? Because otherwise, the economy is in okay shape, but probably at late stages. And I asked Sarah to grab a couple slides for me. So Sarah, if you could show slide number 2. It's a never-ending cycle that we see in economics. It's a recovery, a good growth, a late stage, into a recession, and then back into a recovery again. And I equate it to the seasons of the year. We got winter, spring, summer, and fall. So the question that most people ask is where are we in this cycle? And you can't really point to any one particular data point that says, we're here, this is where we are. But instead, you kind of compile a bunch of data points, and a lot of them are suggesting we're at that fall, we're at the late stage period where the economy is starting to slow down a little bit. We have above trend inflation. The Fed is beginning to put the brakes on. Credit might get a little bit tighter. Profits might see a slumping. There's a lot of points that indicate that's where we are. We're probably in the sort of September, October timeframe of that cycle. And Sarah, you could take that one down now. But we've done, I shouldn't say we, there's people who go out and do surveys of large institutional investors. And there was a recent survey by JP Morgan that asked, where are we in the cycle? And the number of people that responded were at the late stage of a cycle spiked up within the last month and a half. About 60% indicate they think we're at the late stage of a cycle today. So that's kind of the footprint we're standing in today.
All right, thank you for that graphic. So I'm thinking about if we're sitting in kind of that fall point today, what does that mean for where we go next? How do things change as we move forward? Are we headed to that winter spot I saw on your slide?
Yeah, the Fed will be the real driver of where we end up over the next 2 years. And as I said, they've let inflation jump up higher than they probably would have liked to have seen. They called it transitory, 6 months ago. And I think at the time, kind of people claimed foul on that they didn't think that was true. And now you have Fed governors admitting that it's not transitory and they need to do something about it. They're probably behind the 8 ball. The inflation numbers today, just as they sit today, suggest, we could probably see the average family has a cost increase of about $5,200 a year. About $2,200 of that would be related to just food and energy. And so the Fed has got to kind of step on the brakes in order to slow that down. Now, just last week, they raised their short-term interest rates by 25 basis points. And that's really the first move in what probably many expect to be a very long cycle of Fed rate tightening. And Sarah, if you could show slide number 3, gives you a sense of today where the expectations are for the short-term interest rates. If I had shown you this exact slide a week ago, it would have said 25 basis point increases at kind of each of these different spots. But after the Fed's announcement last week, they came out pretty publicly and said that they would not only continue to raise it at each of the meetings, but there was a pretty decent chance they'd raise it 50 basis points instead of 25, not only in the upcoming meeting, but potentially 2 or 3 times later in the year. So we're going to see the Fed really trying to slam the brakes home. Now, one of the issues is the Chairman Powell, he's the chairman of the Federal Reserve, he acknowledged that they have to watch the yield curve for signs of recessionary risk because the Fed has historically, by slamming the brakes on the economy, caused a recession. That's just how the economics work. And Sarah, you can take that one down now. We've got a signaling in the market right now that a recession could be on the horizon. So there's a great indicator in the yield curve. And if I can figure out which way, I think we go this way. The yield curve normally looks like this. It slopes from the left to the right. Short-term interest rates are lower than long-term interest rates. That is a standard yield curve. However, when the Fed starts raising the short-term interest rates and the long-term rates don't move, you get a break. You get what's called an inversion. An inversion is a really good economic telltale sign that a recession is coming. So if you take the short term and minus the long term and it's negative, the market is saying the Fed is putting on the brakes up here, but in the long run, we think interest rates are going to come down because economic activity is going to slow so much that we're predicting a recession. Today we're about here, but it's headed to here. And as people point to it, they say, man, a recession might be in our near future. But I think there's a flaw in this argument right now. While we are tipping a little bit towards inflation, or at least to flat, the market is assuming that the Fed can rein in inflation in the long term, that they can take that inflation rate from 9 or 8 or wherever we are today to something more like 3 or 4. I think that's going to be a lot harder than the market really anticipates. So what you're going to see is you're going to go from this to back to this again, I think. Once the Fed begins to, or not the Fed, once the market begins to realize that, you know what, I may not want to have a low interest rate on my 20-year piece of paper that I'm buying because inflation's going to eat that away. So it takes a little bit off the luster. And I think if you look at the consumer, and the consumer represents about 70% of GDP, the consumer's not afraid of their own personal finances. They're not afraid about job. They're afraid about the economy as a whole. They're afraid about major purchases and new homes. So they're not worried about their wallet. They're worried about your wallet. And usually that's not the signal that a recession's coming soon. The recession comes when the consumer's worried about their own wallet.
Got it. Thank you for that visual aid. I think many of us have seen headlines that do an inverted yield curve. So it's nice to kind of see that visually laid out. We do have one question in the comments that I want to refer us back to before we move on here. Kyle asked, what's the typical GDP growth?
Yeah, I think it really depends on where you are historically, but I think he wrote in here 3% is probably a good target. As our demographics age and we have a larger percentage of the population not working, it's really hard to get to 3%. So a 2.5 or a 2.3 would actually be not terrible. But yeah, 3, I think, is where many hope we can run at.
Great, thank you. I do want to shift our focus a little bit now. Talk to us a little bit about how the conflict in Ukraine specifically has changed things for the global grains and the U.S. farmer.
Yeah, and there's really 2 different aspects to that. Let's talk about the corn market, or the corn and soybeans market. It affects wheat too, but I'm kind of lacking in knowledge about wheat, so I'm going to focus on corn. But take whatever I talk about in corn, and you can almost multiply it because their contribution to the global wheat market's even bigger. But over the years, Ukraine's really become a larger player in the corn market. They represent a small percentage of global production, but a decent percentage of global exports. They represent about 15% of global corn exports. Most of that goes to the Middle East, Africa, and then China. Now, conversely, the US's exports, only about 10% of US exports go to the Middle East and Africa. So we're not usually competing for that grain market. However, if you were to take a look at the situation where we have today, I don't know how Ukraine is going to get a crop in the ground, never mind how they're going to export it. And Sarah, if you can bring up slide, it's off my screen, but it must be the next one. Yeah, thanks. The slide on the left shows where Ukraine's corn production is. And it's really heavily concentrated in the sort of northeast part of the country. And you overlay that with the map on the right, and you can see where a lot of the conflict is happening. There's a couple different dynamics here. One, you've got farmers that are probably in an insurgency fight. They're not in their field. They are out fighting. There's those that actually have a field that are in that area that have to worry about disruptions of their field. Does a tank or a missile or anything go out and damage their field? So why would you go about planting a crop if you were going to potentially lose it to an event? And then you have a third aspect to the fact that the government owns about 40% of the arable land in the country for production, and they rent it. And they rent it to European Union citizens who aren't allowed to own the land. So I don't know the exact numbers, but I have to imagine if you're a European citizen who doesn't own the land and is just there to farm it, my guess is you've probably gone home. And I don't know that for sure, but I don't see how you're going to get a crop in this year. And then throw on top of that, my circles are kind of screwed up because I moved them, but Odessa in that bottom corner there is the biggest exporting port in Ukraine. And that harbor is mined. You can't get ships in and out of there anymore. You can't get a lot of the rail systems been disrupted. You can't get, stuff out. You probably can't get fertilizer and seed in. So I just don't see how you're going to see a 2022 crop. I think you could potentially even see a disruption to the 2023 crop. And you're seeing that in the market today. You're seeing places like China really rushing to buy corn in the near term, because there was probably about 600 million bushels of corn that was already in the country that was headed to China that's not getting out. It's stuck. And then there's possibly another 450 million that need to be delivered between March and May that someone has to backfill. Now, corn's a global commodity. It's like water. If you drain water somewhere, the rest of the water will go flow that direction. Global commodities are the same way. So if Ukraine can't get grains to Middle East, Africa, and China, it's either going to come from South America or the United States. They're going to have to supply that void. And today, South America is not really in a position to be able to fill that. They have a short crop themselves. In fact, China has been canceling orders in South America because they're afraid they're not going to be able to fill them, and in turn buying short-term crop, last year crop from the United States. And you're seeing this big change in the near-term market futures to the December. There's about a 80 cents or $1 difference, somewhere in that range, between the current futures contract and the December future contract, because there's a scramble for grain today. I think you could possibly see that continue as the year goes on if Ukraine only gets 30% of its crop into the ground. Oh yeah, thanks.
Interesting. So when we talk about South America potentially not being able to fill that export market, not being able to fill that demand, are there any other scenarios you potentially see playing out this year?
Well, the big one is, we talked about what physically happens in Ukraine. There's Russia. Russia is a world dominant player in the fertilizer market. They're dominant in ammonia, which is needed for the production. So places like Morocco, where we might want to get phosphate fertilizer from, relies upon Russian ammonia to do that. So they play a really large role. Now there are North American producers, but their capacity and ability to increase is probably limited to some degree. So while the fighting in Ukraine could stop tomorrow, and in fact, there was a movement in the grain markets yesterday because there was talks about a ceasefire. As long as Russia stays there, and as long as there's Russian aggression, we are likely to see sanctions on Russia go forward. That means they can't use their banking, the global banking system. You can't make purchases. You can't have assets there, and they have actually pulled back some of their exports in retaliation. So we could have a real shortage of fertilizer on the global market over the next year. Could it be 2? Could it be 3? That's an unknown. It'll definitely be in the next 6 to 8 months. Now, the good news for the U.S. farmer is most of that fertilizer is on U.S. soil. And I say that with somewhat pun intended. It's in many cases literally in the soil already. And in other cases, on the nitrogen side, it's actually sitting in U.S. storage facilities. So of the clients I have talked to, almost all have said, I've bought fertilizer, I know where it is, and I think I have access to it. So that's the good news for the U.S. farmer. We should be able to have a pretty good crop production for 2022. The one that may take it on the chin is Brazil. Brazil relies 90% of its fertilizer use from Russia, and their growing season for next season isn't until the fall. Our fall, their spring. And those contract negotiations for fertilizer prices have not happened yet. So not only do you have to worry about La Nina there, they may not have access to fertilizer. And if you just look at the U.S. market today, 2021 fertilizer prices per acre were approximately $145 per acre. They will be higher for that. Oh yeah, thank you. Thanks, Sarah. If you looked at how you spent fertilizer prices in 2021 for the 2022 year, you're probably looking at, somewhere between 190 and maybe 220 an acre. If you were to reprice that on today's market, so I had to go out to today's market and buy that, you're probably talking about $260 an acre. And that's if you use urea, which is cheaper than anhydrous. Anhydrous, you're probably talking over 300. So 2022 is good. Fall of 2022 is going to be tough for South America. Then the real question is what does it mean for 2023 in the United States? And unfortunately, I don't have an answer for that. There'll have to be a lot of individual decisions that are made as how do you prepare?
Well, that's a good question. So moving beyond just fertilizer, what could or should producers be doing right now, given these new and highly volatile market forces?
Yeah, and that's such a tough question to be able to predict the future with a crystal ball, because I've got a bunch of stuff behind me and none of them are crystal ball. But the reality is it rests on your ability to maintain proper risk management. So how do you hedge? We're in a good situation today where commodity prices have outpaced that of input prices. As you move into 2023, it becomes a little less clear, but it's still possible to lock some stuff in. So do you make a proper marketing plan and understand, how much I want to lock in for the future and how much do I want to let float? How much do I want to consider about how long might I be willing to delay nitrogen purchases, as an example? Maybe I normally buy it in May. There's going to be a decision you need to make, and it's going to be made on an uncertain future. Do I lock it in early, even though the prices are high, if I can in turn lock in a good price for my output? Or do I wait to see if the conflict gets resolved and maybe my backup plan is use less nitrogen next year? And so maybe I hit the springtime and say, all right, I'm not willing to pay $1,500 a ton for anhydrous. And so maybe I need to switch my practices. And we could probably go another crop year with less nitrogen. Can we go 2 crop years with less? That becomes a little bit harder. But it's all going to be making a plan of what I'm comfortable with today. And when you look back, be comfortable with that decision you made, regardless of how the market turns.
I like that. We'll work on getting that crystal ball shipped over to you. I think it's stuck on a shipping container right now somewhere. Well, I think that brings us to about the end of our time today. Thank you, Bill, for all of your insights. I know one thing is absolutely true, that the only constant is change. So what we talked about today will likely not look quite the same in 6 days, 6 weeks, or 6 months from now. But for those of you who joined us today, if you do want access to more insights like this, I want to encourage you to sign up for Compeer's Production Ag newsletter. It gets delivered right to your inbox twice a month, really quick and easy. Sarah's going to go ahead and drop a link to that in the comment section so you can sign up for that when you get a chance. Speaking of Sarah, thank you, Sarah, for being the backstage mastermind for today's live session. We really appreciate you doing that. Bill, another thanks to you for joining us. And audience, as always, thank you for spending your time with us. You can catch the next Facebook Live from Compeer on April 19th at 7 p.m. That topic will be on hobby farm financing. So share that with any contacts you have who might be interested in joining for that. Thank you, everyone. Have a great rest of your day.